I would think, although it may not be immediate, because I think they're going to have to reduce interest rates for, somewhat significantly for that to happen. But at some point, I would expect the financial stocks, which are the predominant, the most of the market, at some point, I would expect them to recover from, because they haven't really recovered from COVID. There's a few that are a little cheap, but there's no outstanding bargains in the local stock market. So I'm not sort of banging twice in my life. I've banged the table and said, the stock market is going to double. And twice in my life, I got it right, fortunately. One time my father was in the audience, so I was very happy about that. But I'm not saying that at this moment in time because we're not got a super cheap market. So you have to be a little careful, but a positive interest rate cuts and an economy that doesn't fall off a cliff should nevertheless be reasonably positive for the US stock market.
Charles, what's your one asset class pick?
Well, you shouldn't have to ask. Bonds certainly will do well. It's sort of axiomatic that if yields fall, prices go up. The real challenge will be, picking the best opportunities that are out there in terms of credit quality. But certainly now is the time, I think, to go longer dated and look for some price appreciation in the year or two to come.
I also agree. I am also always surprised at when I look at things like the PE ratio for the US S&P 500, and it's near 30 right now, and it has remained in that range. It's done extremely well very recently, including in the last week. But the markets have remained pretty frothy throughout the last couple of years, even with very high interest rates. You would expect them to do even better with lower rates, but I'm not sure where they can go from here, with the exception of some obviously places, AI linked stories, which are also very, the valuations are quite high, but, at least there's some prospect of acceleration there. In terms of fixed income, obviously longer duration assets are looking good right now. But again, and we still have an inverted yield curve, right? So there are lots of spots on the curve that you could pick that might be attractive with depending rate reductions. But again, I think, rates are not everything, right? I mean, the longer term story is extremely important. And I think, we are all sort of consensus that we're going to have the Goldilocks scenario, soft landing, but there's a lot of risks still out there. And I think, there is uncertainty, and that's really what needs to drive investment decisions in the long run. And also the other thing that I mentioned, which, where do we end up, right? What is neutral now? Where do the Fed funds rate and where do interest rates end up, even in relatively normal context in terms of macro performance? And I think, we're certainly not going to get back down to zero unless there's some kind of global catastrophe again, which may well happen. And we've seen 2 of them in the last decade. But yeah, I think it's a challenging environment, but I think things are looking good.